There are a couple things. I have a whole chapter on, kind of investment suggestions, portfolio allocations, and all that. The main thing to do is a couple of things. They're almost constant, it's not quite because it's not a set and forget it type portfolio, but you definitely want 10% gold, and whether it's physical bullion or some kind of fund. I recommend physical bullion, but if you have an ETF or something, at least you get price exposure. Gold mining shares, you can look at silver miners and all that. But I also recommend a big slug of cash, maybe 30% cash. I recommend lightening up on equities. I think equities have a lot further to fall. There's been a spectacular rally from March 23rd to September 2nd. We had the shortest bear market and the fastest return to a bull market in history. But it doesn't mean this is over. That was sort of, I call the S&P 500, I call the S&P 6, because it's really only six companies that are dragging along the other 494 because it's a cap-weighted index. So you look at Amazon, Apple, Microsoft, Netflix, Facebook, and Google, or Alphabet. Those six stocks are almost 40% of the weight of the index. So they go up, the index goes up. A lot of people don't pick stocks anymore; they just buy index funds. So their index funds go up. So it's all sort of going up together. It's all good, but there are two problems with that. Number one, how sustainable is that? And by the way, there's six companies I mentioned. They're the least affected by the pandemic. Meanwhile, so my point is that the stock market is completely detached from the economy. It used to be that the stock market was kind of a proxy for the economy, not exactly, but to some extent. That's not true anymore. Those six stocks and others like it, they're some of the tech names. They're just in a world of their own. The economy is in very bad shape.
And I'm happy you brought that up, Jim, because you're absolutely right. The stock market is painting one picture, but the economy is telling us something different. So what is the real truth here? And that leads me to my other point about the debate of inflation versus deflation. And I know you're one of the few experts out there saying actually, the Fed wants an inflationary environment, but they might not get it.
Right. Well, I've said that for a long time, and they haven't been able to get it for a long time. It's just literally in the past few weeks that the Fed has come out and more or less admitted this in a couple of respects. So first of all, the idea that money printing causes inflation is just not true. Now, everyone believes it's true. The monetarists, the Milton Friedman followers, the Austrian economists, even the neo-Keynesians say, yeah, if you print a lot of money, you get inflation. It's not true. And just for empirical evidence, I don't just say things like this without backing them up. Between 2008 and 2015, when they ended, 2014 when they ended QE3 at the time, the Fed expanded its balance sheet by almost $3 trillion, and we never had inflation. We never had serious. You get 1.5%, but we never had serious inflation. The whole time the Fed had a target. This is 11 years if you want to go all the way to the end of the expansion in 2019, and technically February 2020. 11 years, and the Fed never hit their target of 2%. A couple months, yeah, but not on a sustained basis, and certainly nothing above that. So I like to say it's a sad day when the Fed wants inflation, you can't get it, and they do want it. So now they've come up with a new monetary policy. They've sort of, as I say, given up on the money printing thing. They say we're just going to let the economy run hot. We're not going to worry about money supply as much. We're just going to basically let unemployment drop, hopefully, and let inflation go. And if it goes above 2%, we're going to let it stay there for a while. So the below 2%, the above 2%, kind of average out to 2%. That's new. Here's the problem: you can say it, you can take a vote and make that your policy. It doesn't mean you can make it happen. They failed for 12 years, for 11 years. Why don't you think they're going to succeed now? The greatest danger in the macroeconomy today is deflation because of declining labor force participation, declining productivity, and most of all, velocity. Velocity is the turnover of money. It doesn't matter what the money supply is. If it's not turning over, if there's not lending and spending, if people aren't chasing the goods, then you're not going to get the inflation. And so, but velocity, as I just described it, is a psychological phenomenon. How do you feel? Do you feel prosperous? Do you feel confident? Do you want to go out and buy dinners on me or drinks on me or whatever, buy a new car set, or do you feel cautious? Do you feel concerned? You saw your neighbor lose her job, you're worried about losing your job, etc. So you save more. Well, the evidence is people are saving more. We're in a liquidity trap. Saving was sort of kind of working its way up from 5% to 8%. In April, it was 33%. In May, it was still 25%. In June, it was 17%. So savings can be a good thing, but in the long run, if you have productive investments, and that's a big question, but in the short run, the savings come out of consumption. If I make money, I'm either going to save it or spend it. Well, if I save more, I'm spending less. So all the signs are point to deflation. If they can say they want inflation, and they can print all the money they want, it doesn't mean they're going to get it.
So despite the zero rate environment, Jim, you're saying that people are still saving.
That is the evidence. They're not just still saving. You're right about that, Danielle. They're saving more than ever. These are like Chinese levels of savings rates. Now, it makes sense, right? If you lost your job, you're going to, hey, I got to pay the rent. I got to pay the mortgage or the kids' tuition or healthcare. So I'm going to save more. I'm going to cut out, dinners and vacations and club memberships and discretionary items. If you didn't lose your job, but your neighbor did, you might be worried, how do I know I'm not next? Look at the companies that went bankrupt. Pier 1, Neiman Marcus, JCPenney, Brooks Brothers, Gold's Gym. I mean, the list goes on and on.
So let me ask you this, Jim. The last time we spoke was in April. Is it safe to say you're more worried today than you were then, or even say a year ago?
Well, a year ago, I was saying that the economy was weak. My last book, Aftermath, came out in July 2019. So it's just a little over a year old. It's not like it wrote 5 years ago. That book's a little over a year old. Go look at page 288 to 291. I talked about pandemic. I said 100% chance. I had two other scenarios. So 100% chance one of them happens in the next 3 years. The pandemic was on the list. So, and I also talked about civil unrest and armed militias in the streets, which we're seeing every night. So everything that's happening now, I forecast in my book Aftermath, which came out in July 2019. You can just go look it up. So my new book, The New Great Depression, is going to take the story forward and tell you what's going to happen in the next couple of years. But the deflation story is not new, Danielle. It's been persistent, and it's getting worse. The Fed does. I could tell you how to cause inflation in 15 minutes, but unfortunately, the Fed kind of forgot how to do it.